I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Richard Quin, Principal and Portfolio Manager at Bentham Asset Management. Richard, welcome.
Thanks, Peter.
Of course, you're a fixed interest house. Can you talk about the role of bonds in typical investor's portfolio?
Yeah, we're a fixed interest house, but probably specialising in credit. So we're a little bit different as a fixed interest house. But generally speaking, in a portfolio, fixed interest provides constant income and some protection of capital. We do that in the credit area. We tend to generate more income, and we protect capital by being higher in the capital structure of a firm. And that's how we do the fixed income in our world.
Has either COVID and or the ultra low interest rates changed the way that you manage money and your universe?
Yeah, absolutely. Like we will put a lot less interest rate risk into a portfolio now because the interest rates are really low. In actual fact, they're negative in some parts of the world still. And that's a real issue for the potential return down the track. So we would actually say that there's going to be a significant change in allocation. You'll get a lot more of your fixed income return from the credit spread that's being provided by credit investments.
And generally, what role or what percentage do you, with a prudent investor, expose themselves to in terms of fixed interest / credit?
The world's changed a bit. So I think the very long interest or the long duration of bond markets, because interest rates are low and people have issued a lot more debt with greater maturities, it's got a very long interest rate duration, and they're much more sensitive to changes in interest rates. And we're now starting to see negative returns from fixed interest markets. Now, the reason we do what we do is we take out the interest rate risk by hedging it. And that means that we get the credit return, and that's enabled us to get slightly better returns than most managers.
Has the current environment made your job more difficult or easier?
I would say more difficult because we've got a changing environment. And we're going through a transition now. We're going through a transition from a time where bonds used to be negatively correlated with equities. We've had 20 years of negative correlation. The previous 20 years, we had positive correlations. And we're starting off at a very low interest rate. And that's a bit of a problem for markets.
And you talk about a transition. Where are we in that transition, in that journey?
I think as we start to open up economies post the COVID vaccinations, we're going to start to see a lot more pressure on inflation and a lot more pressure on central banks to actually decrease the support for the environment. So what you'll see is you'll start to see less buying of bonds, and you may start to see interest rates rise. And that interest rates rising will affect lots of markets and not just fixed interest markets. So I think you want to be in some floating rate credit, to be honest.
Well, incredibly, the Reserve Bank here has said we're going to keep interest rates stable for another couple of years. Does that surprise you? And I'd be interested in your comments on that.
What I think will happen is activity will come and surprise people. I know we're in a lockdown right now, but once we get out of lockdown, I think that people will be doing a lot of activity. There's a pent-up demand in the form of savings, and I think there'll be a lot of activity. And I think when the activity comes through and the unemployment's starting not at a very high rate right now, so I think once the economy starts to open, I think the central bank will actually change its mind, saying the activity's changed. Now, we expect the activity to change, and I think they should probably be a bit more straightforward and say, well, unless certain things happen. But I think they are saying that. They want to see the unemployment rate go below 4%, and I think you'll see a change in interest rates a lot quicker.
It's lower for longer, but maybe not as long as people are expecting.
I actually think we're going to see interest rates rise.
Next calendar year?
Yeah, absolutely. And if it's not the cash rate, it'll definitely be the yield curve. And the yield curve started to raise already. The lows in interest rates were actually last year, probably around June, July last year.
Your talisman fund, the Global Income Fund, has just reported another stellar year. Can we look under the bonnet of that fund, where both the geographies of where you invest and also the sectors? Because fixed interest means many different things, or credit means many different things to many different people.
It does, and it's a very wide universe. I don't think a lot of people understand that the credit markets are much larger than the equity markets. And in actual fact, that's the traditional investment market for people. Prior to the Second World War, only speculative people would invest in equities. Now we've got everyone investing in equities, and maybe they've become more speculative. In our Global Income Fund, we invest in lots of different assets that have structures that benefit the investor, like a senior secured loans. You've got a security against the loan. You're not risking your whole $100 that you invest. Even if the company defaults, you probably get 65 cents in the dollar back, and not many companies will default. And that's actually one of the things that's happening right now. We expected this to be a really tough recession. It hasn't been a tough recession because half the economy's been travelling very well and the other half has been in hibernation, and they're about to come out of hibernation.
So just give us a thumbnail description of the elements of typical elements of the income fund. You've got government, you've got credit, you've got high yield.
Yeah, correct.
Emerging market debt.
We're short emerging market debt right now. We might cover that soon. We have US loans, European loans. We have some bank hybrids, but overseas bank hybrids. We like the European banks because they're getting a lot more support from their governments. They actually insured a lot of the debt that was issued last year. We actually like asset-backed securities, mortgage-backed securities and the like. They can be quite good investments because they give us a good credit spread without much credit risk. And we measure credit risk in many different ways. The thing about a credit portfolio is you need lots of sources of income and you need to be very diversified. Like you wouldn't see industry concentration that large in our credit portfolios. And part of the reason for that is when defaults occur, they tend to nest in particular industries.
Yeah, but you mentioned mortgage-backed securities. That might make some people turn, break out in hives. But it's no problems now.
No, for now, and as everything, because obviously housing prices have risen quite dramatically, and that gives us quite a lot of equity cushion as we're lending in the debt, and we have cushion underneath that as well. So we have a lot of protection for our investment. But in everything, I think you need to look forward in markets. And a lot of what we do is we look at what will other investors be looking to buy in a year's time. I think they'll be looking for floating rate loans. So we obviously have floating rate loans. Bank capital securities, we think banks will do really well out of this. I know it seems strange, but banks were actually helpful in the last 12 months. They showed a lot of forbearance. And hence, that's one of the reasons why the default rate is so low globally.
Well, you've just posted some incredible performance figures, 8.5% for the last year. It's your 18th year of the fund. How do you get figures like that and still offer a liquid investment? Yeah,
and that's actually the thing. Like when we invest in something, we're always looking at the marketability of the asset. Like it's not good enough from our point of view just to invest in an asset and lend money to someone and just wait for them to pay the money back. We have to lend into something that can be traded and priced on a daily basis. And we basically do that globally. And then we have independent parties value our portfolios with market statistics on where the stuff's trading on a particular day. The market can actually be surprisingly liquid when you have lots of different types of investors investing. And like we would compete for investments with insurance companies, banks, funds, family offices, private banks, and alike. There's lots of different types of investors. And sometimes, it's the investor that disappears that creates a problem for a market. So you have to be aware of who's investing in certain things with you at the same time. But this fund's got, I think, a historic average of around 6% per annum, and it's just posted 8%, yet you're offering daily liquidity. That's, in this environment, they must be knocking down the doors. For us, we see a moderate demand from people that know us, and we're not that well known. We're a smaller shop relative to a lot of the bigger players like PIMCO and the like. But I think we do a pretty good job.
What differentiates you from the PIMCOs and others?
I think we're a specialist in credit. We have a connection to and a long pedigree in investing in credit globally. And, you know, the quality of the people that we employ is very high. We're investing with our own money as well. Like, it's not uncommon for our team to have investments in our funds. That would be very unusual relative to a lot of fixed interest people, I think.
It seems to me the average Australian investor somehow understands equities much more than they understand credit and fixed interest. Would that be an observation you'd agree with?
Oh, absolutely. I think.
And why is that?
Well, I think it's the privatisation of Telstra, CBA and alike is part of the reason. I think the Australian investor has been introduced to equities, and equities has had a favourable environment as well. Our high yield fund's done just as well as equities, if not better, with a third less volatility. You know, our high yield bond fund's been a very good performer. So we have investments that we think rival. And overseas, I think older markets, there's always a segment for a fixed interest element. Like there might be 5 to 10% for high yield. There might be more for corporate bonds. In Australia, we just haven't had the experience of it. And also we have had we've been in a very good paddock. It's been very good returns. The Australian share market has been one of the best performing share markets for well over 100 years. And that's something to be proud of. But diversifying away from that a little bit, and especially once people get into retirement, you can't risk all your capital in equities in retirement. Now, I'm not saying that all your capital could be burnt.
Well, speaking of that, is the 60-40 balanced portfolio, is that alive or dead?
I think it's challenged right now because interest rates are so low. Now, if you do have to have that mix, you have to mix it with something else, like because government bonds are, at sub-inflation levels, like, and interest rates that's below your current inflation rate is literally sending you backwards. Your real purchasing power of your money is going backwards by investing in that. It doesn't make sense to me. It really doesn't make sense. Now, the reason people have it is they're running a lot more equity risk and they're barbelling it with bonds that have a negative correlation. So that means they can take more risk. Now, the problem is our starting point is very low interest rates. And we've already extended our duration risk. And I don't think everyone's being truly honest with themselves on how much benefit equities have got through low inflation and low interest rates. There is an effective duration of equities, which is quite long. So I think we've got to be more honest about the return benefit that people have got from lower interest rates. Now, lower interest rates can't stay here forever, and we're in an inflationary environment.
Well, are investors, are open to going to high yield funds like yours and your credit funds like your Global Income Fund? Do they
Some are. Institutional investors.
No,
institutional investors have, and again, like it's our job to help educate investors. And I think the real thing is in post-retirement, if you're looking to generate income, you can do that with a credit fund and not risk all your capital. And again, the speculative nature of equity markets, I think, is underplayed because it's been supported by a huge cash flow and low interest rates. Like if we see a turnaround in interest rates, we'll see a turnaround in a lot of markets. You'll see a turnaround in property markets, fixed interest markets, but you'll also see a turnaround in equity markets. This negative correlation between bonds and equities, I think, is about to come to an end. Now, it hasn't always been negatively correlated. It's only the last 20 years. The previous 20 years, it was positively correlated. So that meant when interest rates went up, equity sold off. I think we're going back to that environment.
But your high yield fund, I think, has posted more than 10% in the last 12 months.
Yep.
Your Global Income Fund's posted more than 8%.
Yep.
Can the average investor, is this only for institutional investors, or can the average investor and SMSF trustee access these funds? What's the entry level?
Yeah, the entry level's fine. It's like $1,000. It can move in and out pretty easily. The one thing I would say is the majority of our investors are institutional investors. We have the large industry funds as investors.
But I don't need to be a wholesale or a professional investor to invest in your funds?
No, they don't. They don't. The majority of our funds are available to the retail investor. And again, it's one of those elements I just don't think a lot of people know about the asset. If they knew about the asset, they might use it a little bit more. It's lower risk. You're not going to get the high kicking returns you get from equities.
What's your relationship like with the advisor community, and what's their attitude to your products? If you can talk generally.
Yeah, no. And again, like, we have known some of them for a very long time. We've also known some of the family offices and private banks for a long time. I think we have a good relationship with them because they've lived with us through some of these financial crises, and we've managed well through those financial crises. I think if there is a financial crisis, I think people come to us to put their money to work because we're good at managing through those. We thrive in that environment. We like that environment. To be honest, if there's a little bit of crisis around, we're not unhappy. Misery is somewhere that we feel a bit of comfort. We're very different to equity guys, and we're not all, we're not the glass half full guys. Not as optimistic, but yeah, we're going to go sailing a little bit more steadily, I think.
Well, just pulling back a bit to look at the big picture before we finish, the elephants in the room seems to me being China, inflation and climate. How do those 2 or 3 major issues impact on your business and your investors, or are you quite comfortable with whatever happens?
I'm never comfortable.
Let's start with China.
Okay, China's interesting right now. It's going through a change, and obviously there's a political change. It's something we'll be talking about in a webinar soon. The big elephant in the room is Evergrande. It's a Chinese development company, issued a lot of bonds globally, US dollar bonds, that are now trading in the 20s, from $100 to the 20s.
Does it have the potential to become another GFC or not, or can it be contained?
I think it's easier to contain. It's definitely not a systemic event because it's not a bank. It's not a bank as such. It's a property development company.
So Evergrande doesn't keep you awake at night?
No, if I owned some Evergrande, it would probably keep me a little bit sleepless. But we couldn't invest in Evergrande because we couldn't get comfortable with the capital structure of the firm, and we didn't like the development model. It wasn't something we could get comfortable with. A lot of people were saying it's a great investment because they were the widest credit spreads. Sometimes a wide credit spread just means
There for a reason.
Yeah, you're getting lured into a trap, a roach motel of sorts. Yeah, that's not somewhere that we've invested. So your other question,
inflation, I think you.
Yeah, inflation. We think inflation is coming through
sooner rather than later.
Yeah, absolutely. There's a lot of supply disruption. We've got a lot of an underinvestment in energy generally. I think we're going to see some inflation come through and higher interest rates generally. I think there is some inflation that's transitory. There's other inflation that's not, and I think some of the disruptions that we're seeing are things. We have a lot of activity coming through next year. And you think about it yourself. Are there things you'd like to do that you haven't done during shutdown? There's probably things you want to buy. There's probably places you want to go. I think, we've invested in some companies that will do a bit better post this shutdown, and we think we'll be well rewarded for that.
And finally, climate. Does that impact you a lot in your business currently or not?
Yeah, it doesn't impact a lot in our business. Like we measure a lot of the issues with this. It's part of our ESG investment process. I think we're going through a transitionary phase right now where we're getting rid of fossil fuels. And that transitionary phase is going to be very, very volatile. And we don't have enough storage of energy. Like, we may generate a lot of renewable energy is actually wasted. It's not stored. So we need to get the battery stuff right. I think the ex-Prime Minister of Australia is doing a lot of hydro stuff, which is very interesting. I think that's interesting stuff. There's a lot of hydrogen sort of stuff coming through as well. I think that technology is interesting. But you're going to have industries that are going to fail. They're going to fail. They're going to be stranded assets, and they're going to be big assets with lots of debt associated.
You won't be
them.
lending to them.
Hopefully we won't be lending to them. Again, there will always be some defaults in a credit portfolio. Defaults by their very nature are unexpected, but we try and anticipate these things, and that climate change is going to be a big issue, and especially probably a preferable thing would have been to price carbon many years ago. To be honest, we could have priced carbon in the 90s, and we didn't. We should have. So now we're going to go through and we're going to see a couple of industries fold. There'll be some unregulated utilities that will have trouble. There'll be some regulated utilities that will have trouble. People that are left stranded in certain parts of the industry will actually may be in trouble too, because a lot of them are on cost recovery basis. If you actually have everyone in the battery living off solar panels, I think it's going to be the wealthier people that can afford that. The cost structure of the current electricity generation will be dispersed over fewer people, and it will be a higher cost. In actual fact, I'm embarrassed to be an Australian where we have such high energy costs. I just don't think that makes sense.
Richard, thanks for talking to us today.
Thank you for your time, Peter. It was a pleasure.